Hello and welcome to our mini master course on our proprietary structured 401k Roth conversion strategy. I will be your host, Scott Shelley, CEO of Apollo Risk Management, the creator of the Protect and Prosper Employee Benefit Portal. Within this module, we will be discovering the Roth conversion using structured income contracts and learn how this strategy can minimize retirement taxes, preserve Social Security benefits, and generate 25 to 50% more spendable income in retirement. Within today's active workforce, Americans are deeply afraid of the economy, inflation, the markets, and running out of money in retirement. A JP Morgan study found more than half of employees want help with choosing investments. Nearly 70% want help with financial wellness, and 85% of employees want help with an income plan. The Roth conversion strategy addresses all. Many employees will need help controlling taxes in retirement to protect their Social Security from taxation. Single filers making over $25,000 and couples with combined income of more than $44,000 will pay taxes on up to 85% of their Social Security benefits in retirement. These income limits combine the adjusted gross income, non-taxable interest, and half of your Social Security to calculate your taxable income liability for Social Security tax purposes. Roth IRA distributions, however, are not included in your combined income, so they have no impact on whether your Social Security is taxable. This module is for educational purposes only. Every investor's financial situation is unique and no one strategy is prudent for every investor. As with every financial strategy, there is a minimum set of suitability requirements. With this particular strategy, a minimum of $250,000 in 401k or retirement investments is required. Expect to continue employment for at least 5 years and are currently or capable of contributing monthly to a 401k plan. And after a thorough analysis of your personal financial situation, it is deemed that you can benefit from tax-free income once retired. Always consult a licensed fiduciary advisor prior to implementing any investment strategy to ensure the benefits perceived can be achieved. Within this module, we will be discovering what a structured 401k Roth strategy looks like and how using this strategy can minimize income and Social Security taxes while maximizing income outputs throughout retirement. This strategy mostly appeals to those who prefer the predictability of more income and less tax. Before we dive into the module, let's look at some of the questions that need to be addressed before getting involved in a Roth conversion. These questions should include, as a fiduciary advisors, we have the lawful responsibility to ensure our clients will experience meaningful benefits before engaging in any financial strategy. At Apollo, our platform and service structure relies on some of the most sophisticated analytical software and tools that ensure our advised participants will achieve that meaningful benefit every time. So we need to ask ourselves, will this benefit me? Will I have more income to spend in retirement? How do I best pay the taxes now? Will taking the money out of play hurt me? What if taxes aren't higher later on? Will I still pay less taxes long term? Will this actually benefit me? Let's take a look at what a conversion looks like. This is our baseline scenario. This is what we want to improve upon. Peter has $250,000 in his 401k and is contributing $1,000 per month. This hypothetical does not include any employee matching Peter may receive. At retirement, based on reasonable growth assumptions, Peter is targeted to have just shy of $400,000 going into retirement. Based on a 5% distribution and a marginal tax rate of 22%, Peter can expect roughly $14,420 in after-tax cash flow. Understand, to generate $14,000 a year, it requires the entire account. If you take any capital distributions, that income goes down, probably forever. If the market crashes, that income crashes. There is no guarantee with the status quo current path. Peter is simply hoping for the best, hoping the market doesn't crash, hoping he won't need to tap his retirement savings for anything, like a house repair or a new car, hoping taxes don't go up and hoping things work out. We believe Peter can do better. We believe there's a better strategy for Peter than the hope strategy. Let's look at what Peter's retirement cash flow and liquidity might look like if he did a $200,000 Roth conversion 5 years before retiring. In this scenario, Peter is going to convert $200,000 of his $250,000 into a Roth 401k using an in-plan structured income contract. Peter is then going to use a legally permissible 401k loan of $50,000 to cover the income taxes due on the Roth conversion. Since the loan repayments are roughly equal to Peter's existing monthly contributions, there's relatively no impact on Peter's cash flow or paycheck and no large loss of capital in paying the taxes. As Peter repays the loan interest charged him by the plan will actually be captured by Peter back in his account. Peter will pay himself interest by acting as his own bank to pay the taxes. And so those interest gains captured mitigate any investment losses that may have been suffered on that $50,000 while it was in use elsewhere in paying the taxes. So why do we use a structured income contract? For the simple reason it provides a defined income guarantee. The rate of return required to generate the same defined guaranteed income is unachievable for all intensive purposes in a traditional asset allocation portfolio. In this example, $100,000 would generate a guaranteed $11,300 for life. To match that income withdrawal on a 60-40 portfolio, you'd need a 16% annual rate of return. You would have to grow the $100,000 to $283,000. It's never happened before, and it probably never will. Structured income contracts provide us a level of income that simply cannot be achieved in a traditional asset allocation portfolio or mutual funds. Structured income contracts are issued through insurance companies, and contract benefits rely on the financial stability of the issuing carrier. At the time of this presentation, the example contract was available for inclusion in 401k plans in most states. So looking back at the scenario of Peter converting $200,000 into a Roth 401k, Peter will enjoy $20,000 of annual tax-free income in addition to a repaid 401k account that's estimated to be worth $68,000. This $68,000 retirement account is completely liquid. It provides completely discretionary capital available for Peter and his wife for anything they choose. The best part is that he can spend it without compromising his core lifestyle income. This is our baseline scenario. This is what we want to improve upon. Understand, to generate $14,000 a year, it requires the entire account. If you take any capital distribution, that income goes down, most likely forever. If the market crashes, that income crashes. There's no guarantee with the status quo current path. The Roth conversion path, however, using only 80% of the account, or $200,000 of the $250,000, to generate in contract $20,000 a year tax-free, no questions asked. No need to worry about the market, no need to simply hope. The conversion path will provide an estimated 25 to 50% more spendable cash flow based on marginal tax rates today. We are of the belief that these tax rates won't drastically fluctuate in the future, but rather additional surcharge taxes will be added to the base rates on taxable income. Generating tax-exempt income should remain exempt from new taxes as well. Peter no longer is hoping for the best. He knows the outcome. A market crash won't matter and tax hikes won't matter. Peter knows things will work out just fine. The conversion path creates an estimated $68,000 in liquid investments at retirement, while the current path provides no discretionary liquidity without negatively impacting the income being received. To create the maximum income, the current path requires 100% of the assets and provides no liquidity in the case of an emergency or Peter wants to have some fun. Again, our Roth conversion outcomes side by side, year 6 on a $200,000 conversion. Using a very specific structured income contract would provide $20,000 of guaranteed tax-free lifetime income and an estimated $68,000 in liquid discretionary investment account. The Roth conversion strategy takes a regular retirement plan account and converts part of it into a guaranteed, predictable, tax-exempt lifetime pension for the owner and their spouse. So now let's revisit those questions. Will this benefit me? I think we've addressed exactly how this can benefit you. Will I have more income to spend? Yes. How do I best pay the taxes? Our team will help you structure a proper 401k loan to create no impact on your cash flow or savings today. Will taking money out of play hurt me? Absolutely not. It will create more income on top of providing more discretionary liquidity as you go into retirement. What if taxes aren't higher? Doesn't matter. Even if taxes were 10% in retirement, the strategy would produce more income and provide greater liquidity. Will I pay less tax long term? Absolutely. A $50,000 tax payment today is estimated to avoid $130,000 in taxes in retirement on $540,000 of income projected throughout retirement. This doesn't take into account, for many investors, the conversion will protect their Social Security from being taxed. Easily 6 figures of tax savings over a normal retirement. So at the end of the day, will this actually benefit me? Most likely, yes. Imagine having a complete income protection, a lifetime pension for two, protected from market losses, outpacing inflation, and untaxed by the government. That would be the power of executing a structured Roth conversion in your 401k plan. And while we all know there are no free rides in life, let me leave you with this. The fees that we pay for stocks and bonds, mutual funds, and index funds are a fee for access. We are paying for access to that market space. It's a pay-to-play model with no guarantees of success. When you're playing in the structured index field, the fee is for protection. Your fee is going to protect your principal, protect your earnings, protect your income, protect your spouse, provide asset protection. Structured contracts are a pay-to-protect model, where your success is guaranteed in writing by the contract. If you would like to discuss a Roth conversion with someone on our team and how they might enhance your income stability, protect your Social Security, and lower taxes in retirement, use the link below to book a discovery call with someone on our team. We hope this education has been of value, and as always, managed financial risks enhances financial and income outputs.